Hello. This is the final chapter of the investment theory class 438. Chapter 17, Futures Market and the Risk Management. So this chapter tells us about the futures market. We already learned option market in chapter 15 and 16. And now this is the final chapter of the derivative security. We learned forward contract and futures contract. So what is the forward and futures contract? First of all, the title is like futures contract, but we start with the forward contract actually. Why? Because the forward is actually the initial form of the futures. So forward contract is the arrangement calling for future delivery of asset at agreed upon price. Means that, so suppose there's a farmer who wants to sell corn, and this farmer concerned that, well, in the fall when the farmer harvest, the price may drop, so they don't. The farmer cannot make enough money, enough profit. So they want to find the counterpart who wants to buy this corn at the same price, that the farmer wants. Okay. If they agree like $30 per bushel as a price, then they got a forward contract. So they agree future delivery. I'm sorry. If there's a delivery date, suppose like say October 30th, like example. So they have delivery date, and they have asset here like corn, and agreed upon price. Here like $30 per bushel. Then what happened is they basically agree this price, which is called a futures price. The $30 per bushel is the futures price. And there are two parties, right? There is a farmer and there's like buyer, right? So farmer sell the corn and buyer pay money, right? So farmer is seller, and this buyer is the trader who commits to buy asset, purchase asset. We call this position is long position. So this is long position. And now this farmer who want to sell, right, is the trader who commit to deliver asset, so sell the asset, called short position. So farmer is short position. So this is fairly simple. They basically agree the price and the delivery date in the future of any assets, like, doesn't have to be physical asset or agricultural goods, any asset, and promise, like commitment. So it is commitment. They should follow this commitment. They should keep the promise. So it's not like option, as we saw in chapter 15 and 16. Option contract gives one party priority to make a decision, right? Which is option holder. Futures contract, forward contract, both parties has the same commitment. There's no decision maker. They should keep the promise. So, this is bilateral OTC contract. Now, if we want to set a kind of structure to trade these kinds of forward, then we can trade the derivative security, so-called futures contract. So futures contract is more structural contract with exchanges. There's a clearinghouse who handle this job. The concern for forward contract is we are not sure if our counterparty keep the promise, right? So with futures contract, with exchanges, with clearinghouse, we are sure that they keep the promise. The exchanges require to have margin account, to require investor to have margin account so that they are sure if they can collect the money from one party to the other, basically, right? And they basically change the accounts based on daily market price, which is called daily marking to market. We'll see how to do later on. So there's a difference between forward and futures. Forward contract is bilateral contract. It's not structured. It's basically just two-party contract. But futures contract is more structured with exchanges, and there's a margin accounts, and the account changes daily basis based on the market price of the asset. But the basics are the same. Basics are the same. So this is the diagram like for the futures contract, futures or forward contract. So the first one is the long position. So you buy, then if the price keep rising, then you are profitable. So such as, so you do, so let's say you have futures price $30, and on delivery date, the price become, say, so let's say PT. So in delivery date, say price is $35. It means that for buyer side, you only pay $30 for $35 goods, right? So it's profitable. But for the seller side, short position, you're losing money because you lose opportunities to sell these goods at 35. You just have to sell for $30. And you have to do because this commitment. So you lose money. So long position futures profit basically just linearly increase, short futures linearly decrease, unlike this option. You can have many futures contracts. This is samples of the futures contract. Foreign currency, agricultural goods, metal, energies, interest rates, equity index, and so on. So there are many futures contracts. The biggest futures market is in Chicago CME Group, Chicago Mercantile Exchanges. Okay. So next part, we'll see the trading mechanism of the futures contract.